love dividends. I love dividends. I love stocks that pay dividends. Stocks pay dividends tend to produce higher returns than those that do not. S&P dividend payers were up 6.5% versus 3.6% for non-dividend payers. Since 1928, dividends have accounted for over 40% of the total return on stocks. Since 1980, dividend payers have averaged an annualized return of 15.1% versus non-dividend paying companies of 12.8%. So you decide. Okay, let's look at other dividend characteristics. So you have your stock dividend. So when a company uses a stock dividend and it is declared by the firm, additional shares of stocks are issued to existing shareholders. Stock dividends may be used as a substitute for the cash dividends, but they have no value because the stock prices adjust to the stock dividend accordingly. Stock splits occur when the firms give shareholders new shares in exchange for each share they own. The main difference between stock dividends and stock splits is that dividends are additional issues and stock splits are exchanges. And let's look at dividend reinvestment plans. Allows shareholders to automatically reinvest their dividends into additional shares of the firm. DRPs provide investors with a convenient and inexpensive way to accumulate capital without paying brokerage commissions. Despite these cost savings, the dividends paid through DRPs are taxable as ordinary income in the year they are received, just as if they had been received in cash. Okay, let's look at the different types of stocks. The first one here is blue chip, or common stocks of very high quality that have a long and proven record of earnings and dividends. They offer a respectable dividend yield with modest growth potential. They are often viewed as a long-term investment vehicle. They have low risk and provide modest but dependable rates of return. Of course, you can see some examples right there: Citibank or Group, Procter & Gamble, Home Depot. And figure 6.5 here shows a blue chip stock of UPS here, and this record report is from Standard & Poor's. Find all the different information that you need to know about this company. Currently here it has a beta of around 0.5. Like I said, we're going to talk about beta later. It shows the dividend rate, all kinds of information, earnings per share that you would need before you purchase UPS. Okay, let's turn to income stocks here. Income stocks are issues that have a long and sustained record of higher than average dividends. These are ideal for investors who desire high current income with little risk. Unlike other types of income security, bonds for instance, holders of income stocks can expect the amount of dividends they receive to increase regularly over time. One disadvantage of these stocks is their generally low to modest growth potential. Examples here, you can see Bell South, Ford Motor Company, I think just started here recently paying dividends again. Back in 2006, I think they stopped for about 4 or 5 years. Bank of America, Verizon, CenturyLink, of course one of my favorites would be Frontier Communication. Okay, let's look at growth stocks. These are stocks that experience high rates of growth in their operating and earnings. A sustained rate of growth in earnings and above the general market. Investors expect higher price due to the increase in earnings. Look at this one right here. This is a riskier investment because prices may fall if earnings growth cannot be maintained. Okay, a lot of your growth stocks here, like I said, you can actually lose principal. Now, we've talked about blue chip stocks, income stocks, and growth stocks so far. You also have mutual funds that are categorized in these different types options. If your 401k is in a growth stock type mutual fund, it means you are in a riskier type of investment. No problem with that. But just know that if the market goes down, you have a good chance of also losing. Now, growth stocks may include some blue chip stocks. Typically pay little or no dividend because you're looking for growth. Okay, let's continue on with the types of stocks here. You have your tech stocks. And again, like I said, you can have a tech stock mutual fund here. These are issued by companies in the technology sectors. Issuing firms produce everything from computers to internet content. They typically are growth stocks or speculative stocks because they are pose considerable risk to the investor. The sector has done extremely well in good times and has done quite poorly in bad times. Then again, I have no problem with tech stocks, but consider the risk and the price volatility that you would face if you purchase. And when you're talking about diversification, hopefully in your diversified portfolio that you're doing for your project, you do have some tech stocks. Okay, continuing on here with types of stocks, speculative stocks that are offered potentially for substantial price appreciation, usually due to some special situations such as new product. Companies lack sustained track record of business and financial success. Earnings may be uncertain or highly unstable. Potential substantial price appreciation. Stock price subject to wide swings up and down. And here are some examples: Sirius Satellite Radio, DreamWorks, Liberty Media. So here, if you pick this type of stock, you would require a larger return for taking on this type of risk. Okay, cyclical stocks. Stocks whose earnings and overall market performance are closely linked to the general state of the economy. Stock prices tend to move up and down with the business cycles, tend to do well when the economy is growing, especially in early stages of the economic recovery, tend to do poorly in slowing economy. Best for investors willing to move in and out of market as the economy changes. And here are some examples. Okay, let's look at defensive stocks that tend to hold their value and even do well when the economy starts to falter. Stock prices remain stable or increase when general economy is slowing. Products are staples that people use in good times and bad times. Electricity, utilities, beverages, foods, and drugs. Gold stocks are a form of defensive stocks. Seeing the stock prices going for gold going up here lately. That's for aggressive investor looking for a parking place during the slow economy. Okay, let's look at market capitalization. U.S. stock market segment based on stock market capitalization. You also have these categories for mutual funds, small cap stocks less than 2 billion, mid cap 2 billion to 10 billion, and large cap more than 10 billion. Okay, let's look at large cap stocks. Large companies with market capitalization over 10 billion. Number of companies is smaller, but account for 80 to 90% of the total market value. Bigger is not necessarily better, tends to lag behind small cap, mid caps, but the prices are more stable. And here are some examples: Walmart, Home Depot, Microsoft. Mid cap are your medium-sized companies. Like I said, between 2 billion to 10 billion provides opportunity for greater capital appreciation than large cap, but less price volatility than small cap stocks. Usually have a long-term track record for profits and value. Sometimes these are called the baby blues, offer the same characteristic of blue chip stocks. And here are some of your examples. Okay, let's move to your small cap stocks. Less than 2 billion provide opportunity for above average returns. And look here. Don't forget the losses. Usually do not have a financial track record. Earnings tend to grow in spurts and can have which can have an impact on stock prices. Usually not widely traded. Liquidity is an issue. Of course, you have a lot of your IPOs that start off this way. One of my favorite places to eat, California Kitchen, would be an example. Just like I said here, we're talking about stocks here, but you can transfer this over to mutual funds. If you're in a large cap stock, less risk. As you go down to mid cap, you're taking on more risk, and you're taking on a lot more risk when we are talking about your small cap mutual funds or stocks. Okay, let's look in investing in foreign stocks here. Less than 50% of the world's equity market is in the U.S. stock. For most part, the U.S. stock market has been one of the best places to invest over the past 25 years. However, the United States finished first in only 1 year during the 1981 through 2005 period. Thus, to achieve greater returns on their portfolio in a given year, investors should consider foreign markets. Furthermore, the appreciation value of foreign currency relevant to the U.S. dollar would enhance foreign equity returns. Okay, let's talk about going global and buying foreign stocks here. The U.S. investor can either invest directly in foreign markets or indirectly by buying American depository receipts, ADRs. All things considered, American investors are probably better off with ADRs because they would avoid many logistical problems that arise with direct investments. ADRs are dollar denominations and are easy to buy or sell on the U.S. stock market. Then again, I'm going to bring up mutual funds. I'm not an expert when we're talking about foreign stocks here. So myself personally here, now this is my opinion, I would probably use a global mutual fund for my diversification for my portfolio. And going on with just what I stated here, international investing is more complex and riskier than domestic investing. International investing requires investors to be right on most factors. They must pick the right stock, they must pick the right market, and they also have to consider the value of the dollar, pick the directions for currency exchange. Now let's look at returns for foreign investments here. A stronger U.S. dollar has a negative impact on foreign investments, and a weaker U.S. dollar has a positive. So, when looking at the total return, U.S. dollars, you got to take in dividends if the stock pays a current income or dividend, plus the capital gain or loss for that stock. And then here's the one of concern here, the change in currency exchange rate. So you have three different factors here in figuring out the total return for a foreign investment.